Hey there, my name is Alonda Carter, and I am the Recovering Hunbot. I typically make anti-MLM, that's anti-multi-level marketing videos, and some true crime. But today's video, though, branches into the world of financial crimes. In the US, most people keep their money in financial institutions. In fact, roughly 95% of the country is banked. Maybe you have a checking account, a savings account, perhaps a CD, or maybe a credit card at the same bank. Overall, banks have been seen as a way for people to accumulate wealth. But banks have to make money too, right? So how do they do that? Well, there's all those various different fees that they have in place so that they can make money. At one time, there used to be personal bankers. You'd walk into the bank and you'd be greeted by someone, and you would have someone who was your personal banker. As a little girl, I remember going with my parents, and we went to a bank that wasn't one of those huge banks. It was a local bank. And my parents knew the president, Ralph. So when I was old enough to have a checking account and a savings account, I knew Ralph too. So if there was ever an issue, all I did was ask Ralph. But the world of banking has changed since then. Gone are the days of drive-through banks. And I really kind of miss that. I liked being able to go through the drive-through because now I'm like forced to go inside the branch, and I'd really just do the drive-through. But that's a thing of the past these days. Overall, we put our faith and our trust in financial institutions because we expect that we are being guided by professionals, and we expect that we are being treated fairly. Today, I'm going to tell you a story of wide-scale fraud that happened not that long ago. I know most people who are interested in true crime, they're looking for those, stories of intrigue about murder and, who did it, that sort of a thing. Well, there is crime involved in this. In fact, this financial institution kind of encouraged its employees to commit financial fraud. So if that intrigues you, go ahead and stick around. Keeping your money under the mattress was not uncommon after the Great Depression. During that time, banks had the majority of people's money lent out in car, consumer, and home loans. People lost faith and started taking out their money so that they could be in control. In a scene from the classic movie It's a Wonderful Life, the townspeople rushed to the Bailey Building and Loan to withdraw their money. However, there's not enough cash on hand for everyone to do so. George Bailey, played by Jimmy Stewart, is able to convince everyone not to take out all of their money because the building and loan is not a commercial bank. The frenzy to withdraw funds in unison illustrates the fragile nature of our overall system when people lose trust. If you have never seen the movie, I urge you to do so. Everything works out in the end because, after all, it's a movie. Wells Fargo's six-horse stagecoach perhaps is one of the most recognizable symbols in the U.S. banking industry. During the height of the gold rush on March 18th of 1853, to serve the banking and express needs of California, Henry Wells and William G. Fargo founded Wells and Fargo Company in San Francisco. By 1888, Wells Fargo stretched across the U.S. from the Pacific to the Atlantic. For about 150 years, Wells Fargo saw steady growth. In 1998, it merged with a financial service company based in Minneapolis, Minnesota called Northwest Corporation. Richard Kovacic, the CEO of Northwest, transitioned to the helm of Wells Fargo and held that position from 1998 to August 2005. During his tenure, he had tremendous focus on selling multiple bank products to customers. He thought of branches as stores and bankers as salespeople. Before the merger, he had initiated Going for Great, which meant get people to buy 8 products from the bank. Why 8? Because it rhymed with great. His banking style and philosophy would remain part of the Wells Fargo cultural fabric. A decade later, Wells Fargo bought the Charlotte, North Carolina-based bank called Wachovia. This marriage of financial institutions came about because of the financial crisis of 2007 to 2008, which was felt worldwide. At the helm of Wells Fargo sat John Stump, a former executive of Northwestern, who embraced the overall philosophy of Northwestern. Before I get into the fraud, I need to explain how the financial crisis of 2008 came about. In the 1990s, the home building industry began to consolidate, and this created large public home building companies. These companies built homes quickly, and the supply began to outpace demand. Beginning in 2006, mortgage lenders had an incentive to write as many mortgages as possible because they made money on the mortgage origination fees. They did whatever they could to put as many qualified buyers, those with good credit scores, into homes. After all the qualified buyers were in homes, there were still a lot of empty homes. Many of these buyers were offered adjustable rate mortgages. The first 2 years, what they paid for their mortgage was reasonable and affordable. This was because they paid below market interest rate for those first 2 years. By year three, a higher interest rate kicked in, and people were not able to keep paying their mortgage because it was too high for what their income was. Mortgages went into default, homes foreclosed.
When homeowners default on their mortgage, the lender gets the house, and houses are always increasing in value. Since they're covered if the homeowners default, lenders can start adding risk to new mortgages, not requiring down payments, no proof of income, no documents at all. And that's exactly what they did. So instead of lending to responsible homeowners, called prime mortgages, they started to get some that were, well, less responsible. These are subprime mortgages. This is the turning point.
In total, 861,664 families lost their homes in foreclosure during 2008. Housing prices also declined sharply, which meant people owned homes that they paid more than what the home was actually worth. Wachovia had many customers who were not paying their mortgage. The stock plummeted, and equity owners were nearly wiped out. Federal regulators worked out a deal between Citigroup and Wachovia, which allowed Wachovia to continue their day-to-day operations. However, Wachovia was having clandestine meetings with Wells Fargo. During this time, the Internal Revenue Service announced any company that bought a troubled bank would receive huge tax benefits. This would help the worldwide banking system avoid total collapse. And this is how Wells Fargo picked up Wachovia. Overall, when you take into account the tax benefits, Wells Fargo paid nothing for Wachovia. Wells Fargo enjoyed the reputation of being secure and reliable. The public trusted Wells Fargo. People believed the bank was looking out for their best interests, and they were confident their money was secure. Although Wells Fargo leaned into a small town all-American image, today its revenue is estimated to be $82 billion. Today in 2021, its reputation is tarnished. You see, in 2016, it became public knowledge that this trusted institution was involved in an enormous fraud scandal. In some ways, what was happening at Wells Fargo reminds me a bit of multi-level marketing, which I'll explain a bit later. Wells Fargo banks had morning huddles, and everyone had to announce their goals for that day. The branch manager would ask each person how many accounts they were going to commit to that day. There was a well-known mantra at Wells Fargo: 8 makes great. Do you see how the concept of keep selling products to the same people over and over and over spilled over into the Wells Fargo banking culture? Think of it as a mini pep rally to get everyone jazzed up. Throughout the day, the bank manager would check on each person and ask how many accounts they had opened. And then the bank manager would come by at noon, 3, and 6. This put a lot of pressure on the employees. And they were not so much as giving advice to people, but selling them on various banking products and services. In a lot of ways, the atmosphere was very much like a boiler room. The bankers felt they needed to close the deal and open accounts at any cost. This pressure is not unlike what it is like to be involved in multi-level marketing, where distributors will buy products just to hold rank or beg their family and friends to join or buy products. Both are very unhealthy and take a psychological toll. The pressure to perform and meet the quota caused Wells Fargo employees to take drastic actions, which involved opening accounts any way they could. One banker began to internally question what was going on. The town where she worked had a population of 5,000. How is it that every day each of the 5 bankers at the branch would be able to open 8 accounts? It didn't add up in her head. If each week the 5 bankers opened 8 accounts a day for 6 days a week, that would be a total of 240 accounts a week. That would mean at about week 20, every person in the town would have an account at Wells Fargo. Then what? There would be no more people who could open an account. This is eerily how multi-level marketing works. An opportunity is sold to people that anyone can do it. But the problem is that there is pressure to recruit, which is almost impossible for most. And this pressure to recruit is built into the overall system. Recruiting in MLM is tied to the compensation plan and various bonuses. Wells Fargo tied their bonuses to meeting sales goals, that of opening 8 accounts each day. The bonus structure went up the chain of command, but relied on those at the bottom to hit their goals. Enter cross-selling. Cross-selling refers to selling multiple products to consumers. If a consumer had a checking account, they would then be encouraged to open a savings account. Next, they might be encouraged to open a credit card or to take out a mortgage. Meanwhile, the shareholders saw their stocks soar as more accounts were opened and the bank fees collected. Wells Fargo had an event called Family and Friend Days. When that event rolled around, the account goal doubled from 8 to 16. An impossible goal was already established, and yet there was added pressure to continue to open more and more accounts. The pressure to open accounts led Wells Fargo employees to opening unauthorized bank and credit card accounts, a practice that was started in 2011 and continued through 2016. Wells Fargo employees were encouraged to order credit cards for customers that were already pre-approved, but not authorized. Over 500,000 credit cards were opened without the customer's authorization. More than 1.5 million checking and savings accounts were opened without customer consent. At times, the process involved moving money out of a legitimate account into a fraudulent one. As a Wells Fargo employee, it became obvious that you just didn't say a word. Those who went to HR would be given excuses for what was happening, and they'd start receiving bad reviews and eventually be fired for not meeting their goals, and then blackballed from the banking industry. When the story was initially broke nationally, Wells Fargo confirmed it had fired 5,300 employees over the past few years. These were the employees who were not part of the Get Along gang.
But what have you actually done to hold yourself accountable? Have you resigned as CEO or chairman of Wells Fargo?
The board, I serve at
Have you resigned?
No, I've not.
All right. Have you returned one nickel of the millions of dollars that you were paid while this scam was going on?
Well, first of all, this was by 1% of our people.
That's not my question. My question is about responsibility. Have you returned one nickel of the millions of dollars that you were paid while this scam was going on?
The board will take care of that.
Have you returned one nickel of the money you earned while this scam was going on.
And the board will do.
I will take that as a no then. Have you fired a single senior executive? And by that, I don't mean a regional manager or a branch manager. I'm asking about the people who actually led your community banking division or your compliance division.
We've made a change in our regional, to lead our regional bank.
I just said, I'm not asking about regional managers. I'm not asking about branch managers. I'm asking if you have fired senior management, the people who actually led community banking division, who oversaw this fraud, or the compliance division that was in charge of making sure that the bank complied with the law.
Carrie Toll says.
Did you fire
No.
any of those people? No. Okay. So you haven't resigned. You haven't returned a single nickel of your personal earnings. You haven't fired a single senior executive. Instead, evidently, your definition of accountable is to push the blame to your low-level employees who don't have the money for a fancy PR firm to defend themselves. It's gutless leadership.
Of the accounts opened, approximately 85,000 of those accounts incurred a total of $2 million in banking fees. Wells Fargo prevented its customers from taking legal action against them by agreeing in arbitration to repay the customers. In the fall of 2016, two former Wells Fargo's employees filed a wrongful termination class action lawsuit in California, seeking $2.6 billion for former employees who would not engage in fraud to meet the unrealistic quotas and were then demoted, later resigned, or were fired. The dismissal was justified because sales quotas were not met. In response to the bad press, Wells Fargo tried to smooth things over and win back trust with a new sleek apology ad in print and on TV. The new tagline went, Wells Fargo established in 1852, reestablished in 2018. But it didn't go over as anticipated. When surveyed, only 27% of consumers were willing to give Wells Fargo. In early September of 2016, Wells Fargo was fined $185 million by the Consumer Financial Protection Bureau for opening these accounts. In the Netflix series Dirty Money, it was stated that Wells Fargo has 70 million customers in the U.S., which means 1 in 3 households have accounts with Wells Fargo. You would think Wells Fargo would learn its lesson after this, wouldn't you? In early 2019, sales goals were still reported as being unrealistic. In April of 2019, new allegations came out against Wells Fargo related to signing up customers for unnecessary insurance policies, and the bank paid the fine of $1 billion. As of 2020, Wells Fargo faced ongoing scrutiny and agreed to pay $3 billion to resolve the allegations of fraudulent activities and avoid criminal prosecution. Out of the $3 billion, $500 million was distributed by the SEC to investors. To put this into perspective, in 2019, Wells Fargo had a net profit of $19.5 billion. John Stump, who was the CEO of Wells Fargo at the height of this fraudulent activity, has been barred from ever working in the banking industry again. He was fined $17.5 million for his role in the fraud. Since then, Wells Fargo has worked to restructure with the goal of this never happening again. In June of 2020, Wells Fargo announced its quarterly loss for the first time in over a decade. Then in September of 2020, the company reported it planned to cut $10 billion in expenses with the closure of 300 of its 5,400 branches, which means layoffs.
Buzzwords, but consolidating, automating, and outsourcing sounds an awful lot like firing people. So, Mr. Sloan, given your statements about how much you value your employees, can you tell us today that you will not be firing any employees as part of this $4 billion cut?
I cannot.
Okay.
And the reason
It
for that
sounds-
is, Senator,
then-
we have an obligation
No,
to
that's
run
all
Wells
I
Fargo.
need. That's all I need to know, because when I look at the numbers, it looks like to me you're going to end up firing tens of thousands of employees to be able to make these numbers.
Senator-
Compensation
Senator-
and benefits for employees by far are Wells Fargo's biggest expense.
There's about 60% of our total
That's right.
expenses, and we're proud of that, by the way, because
And if
in the
we assume an 8% cut in those expenses, that means that you would fire more than 20,000 employees in the next few years. And here's the kicker for me, Mr. Sloan. After telling your employees in March that they were your most valuable resource and that Wells Fargo has, quote, never been just about improving our bottom line, I want to read you what Wells Fargo told Wall Street investors 2 months later in May. Quote, we expect an additional $2 billion in annual expense reductions by the end of 2019. These savings are projected to go to the bottom line.
That's correct. That's
So
what
you're
I just
literally
said.
telling Wall Street they're going to fire thousands of employees.
No, we didn't
above
say
the
that.
bottom line.
Senator, you're using math to then...
Yeah, I do use math.
Yeah, but you're using math inappropriately, Senator. That's not...
Inappropriately?
no,
By
what?
adding numbers?
No, you
I
multiplied
realize
two
there
different
may be
numbers
a
and you
different
applied
way
it to
that
people.
kind of thing
No, Senator,
works
you
at
you
Wells
applied it
Fargo.
to people.
I asked you, can you say you're not going to make these cuts by firing people? And you were very direct. You said, no, you can't make that promise.
I have a responsibility to the 270,000 team members to make sure that the company is in existence and successful
So let's
year
talk
after
about that
year
then.
after
I've
year.
got one more thing I'd like to read from you.
Mm-hmm.
And that is, it's clear that you're going to knock out a lot of employees here. And it gets worse. At the same time you're planning to fire employees, you're promising to spend $11.5 billion in the next year buying back Wells Fargo stock. You've made this public announcement. You have that much extra money. So look, if you stick to your current plan, it's clear that Wells Fargo employees making $30,000 or $40,000 a year are going to get screwed, just like they got screwed in the fake accounts scandal before. It was executives who demanded new accounts be produced at all costs, but it was 5,300 frontline employees who paid for that with their jobs. And now that the fake account scandal has tanked Wells Fargo's reputation, your way of pumping up the bottom line and keeping Wall Street investors happy is to slash costs by firing low-level employees. You know, what happens in these cases, Mr. Chairman, is in these corporate scandals, it's almost always the frontline workers who pay the price, not the executives. And the only way we're ever going to stop these scandals is to hold executives personally accountable, to fire the people who are responsible, and when they break the law, to march some of them out in handcuffs. And until we do that, these scandals are going to continue, and working people are going to continue to take the brunt of it. Thank you, Mr. Chairman.
How could decision makers be okay with placing such pressure on low-level employees? It's not like upper management directly took part in any of this fraudulent activity. Rather, they tied bonuses to it. And for those who were working out there with the public, for them to maintain their jobs, they were pressured into committing fraud. Why would this ever happen? I have one word: greed. In the movie Wall Street, the character Gordon Gekko said, "Greed is good." Greed of upper management and shareholders caused lower-level bank employees to be put in a pressure cooker with unrealistic expectation. Greed begats unethical behavior, in my opinion.
Wells Fargo was closing accounts that should not have been closed.
Velez has filed a whistleblower lawsuit alleging when Wells Fargo was faced with customer complaints of fraud or unauthorized activity on an account, bank management failed to adequately investigate and simply froze or closed the accounts, all to save money.
It could have been ATM, debit card fraud, check fraud, online fraud, any type of fraud.
Mike Mervis and his wife say it happened to them. After finding out they were hit with more than $100,000 in fraud, he says Wells Fargo shut down all their accounts.
I've said to my wife many times, you know, we didn't rob a bank, we trusted Wells Fargo. And that trust was not returned.
Wells Fargo says, "We do believe the bank made the appropriate decision about the Mervis's account." The bank also says it fired Vallis after 2 reviews and that it's thoroughly investigating all consumer concerns, stating, "Our goal is to protect our customers and the bank from fraud, and we want to do so in ways that minimize the risk and impact on our customers." The lawsuit comes after Wells Fargo was fined $185 million for opening 1.5 million bank accounts without consumer permission. Consumer advocates are concerned closures can damage customer credit scores.
It goes onto this permanent record, and this could prevent them from opening up a new bank account.
The Consumer Financial Protection Bureau is currently investigating whether Wells Fargo clients were unfairly harmed.
When is enough enough? How many yachts does someone need? Now that you've heard this story, how can we avoid this type of fraud at this scale from ever happening again? How can we ensure employees are treated fairly and not punished for speaking out about wrongdoing? As a society, I believe it's important for us to help each other. We are continuing to struggle to meet basic living expenses. And as a society, I think we need to find a way to help people who are constantly struggling. Now that the Texas winter storm is over, homes like this one look fine on the outside, but once you walk in, the home is not habitable. There are many people with homes that need repairs, and they'll never be able to repair them because they don't have the money. And they may be living in dangerous conditions simply because they can't afford to fix their home. Do we just walk away from these people because, after all, it's up to each person to manage their lives? Or do we reach out and help them? What would you want someone to do if it were you? I am still questioning, what is the point to hoard billions of dollars while others choose between paying a bill or buying groceries? And why were those at the C level of Wells Fargo okay with people conducting illegal activity? How can we protect each other and our children from this type of wrongdoing? I think we can do better, or at least I hope we can. I guess I look at making these videos as my way of giving back. Stories of wrongdoing need to be told because we can't forget what happened. If we do, we're destined for the same thing to happen again. An endless loop of events in which we seem to never learn from our mistakes. Right now, the housing market isn't healthy. The demand far outpaces supply. Also, because of the pandemic and the CARES Act, mortgage forbearance has allowed people to stay in their homes, but not to have to pay their mortgages right now. Many people have lost their jobs. We are not only in a public health crisis, there's a financial one too. Because interest rates have been dropped to encourage people to buy homes, many have to the point where they are now willing to pay above market price, sometimes $50,000 to $100,000 above asking. Competition is steep. So even though interest rates are low, people are being priced out of the market. In a more balanced market, there's enough housing inventory on the market for 6 months. Right now, there's enough for 1 month. New home construction used to offer a lot of incentives to buyers. In some markets, there's absolutely no incentives. So what's going to happen when forbearance ends? I don't know. I think our economy is in a risky position, and I have no clue what the answer is. What I do know is when people are vulnerable, there's a tendency for some people to take advantage of others.
Tammy says Wells Fargo enrolled them in a government program that protects people who are financially hurt by COVID, putting a hold on their mortgage. But they don't need the help.
I have the ability to pay. I want to pay.
You specifically said to Wells Fargo, I don't need any help. I don't want any help.
Yes.
Wells Fargo continues to do what Wells Fargo has historically done: screw over their own customers, screw over their own borrowers, and they're doing it at a time when interest rates are at record lows, where Americans, understandably, are looking to refinance their mortgages and save potentially hundreds of dollars every single month on the cost of housing. But in order to do that, you need to have a clean credit record. And if you are in forbearance, meaning if there is a suspension of your mortgage payments due to coronavirus, you ain't gonna qualify for a refinance. And guess what? Right now, there are various cases in 14 different states indicating that Wells Fargo is placing borrowers in forbearance without their permission. This is a huge problem and they should be called out for it. Again, when you're placed in forbearance as a borrower, you're unlikely to be able to refinance. It is reported and noted in your credit report, which is why it makes it so difficult to refinance. And by the way, your bank should not volunteer you or do things on your behalf without your permission and without the proper documentation. And that is what's happening with Wells Fargo right now. Now, let me give you some more details on what the forbearance program is, because the program itself is important and it is helping a lot of Americans. But Wells Fargo is exploiting it to prevent their own customers from refinancing and possibly taking their business elsewhere. So to protect troubled borrowers from harm to their credit reports during the pandemic, the CARES Act states that if a bank makes an accommodation to a customer or consumer, such as suspending mortgage payments, it can't report a change in the borrower's status, such as no longer being current on the loan. But Wells Fargo is actually reporting that borrowers are in forbearance, and that indicates a major shift in their status, right? Raising questions about the practice. This goes against what the CARES Act specifically says banks cannot do. Now, last week, NBC News reported that there are borrowers who have been placed in Chapter 13 bankruptcy, with Wells Fargo placing them in forbearance without their permission, right? So they're going through the bankruptcy proceedings. They do not want to be in forbearance, and Wells Fargo is placing them in forbearance anyway, further complicating their process of bankruptcy. Borrowers in at least 14 states have said that they've been forced into forbearance plans by Wells Fargo. That includes Alabama, Arizona, California, Florida, Kansas, Louisiana, Michigan, Missouri, New Hampshire, New Jersey, New York, North Carolina, Texas, and Virginia. Now, why am I mentioning all of those states? Because this is not a mistake, even though Wells Fargo is trying to play this off as one. One of the spokespeople for Wells Fargo said, quote, "In the spirit of providing assistance, we may have misinterpreted customers' intentions in a small number of cases, except it's pretty hard to misinterpret intentions when there's no documentation indicating that these borrowers actually wanted to be in forbearance." So I just want to remind you all that Wells Fargo has gotten into so much trouble before, including signing their clients up for accounts that they did not want, doing it without their permission or their knowledge. And that led to a PR campaign that was laughable, to say the least. Here's a little snippet of that PR campaign.
We know the value of trust. We were built on it. Back when the country went west for gold, we were the ones who carried it back east. By steam, by horse, by iron horse. Over the years, we built on that trust. We always found the way. Until we lost it. But that isn't where the story ends. It's where it starts again. With a complete recommitment to you. Fixing.
Yeah, garbage.
With the interest rate being low the way it is right now, I do wonder if there are some questionable things happening when people either go to buy a home or to rent property. I know last August when we were forced to move because the building we lived in sold and we were looking for a place to rent, there wasn't much on the market. And right now there are some renters who have not paid their landlords due to the moratorium on eviction. But those landlords still owe property and some are still paying their mortgage on it. None of this can last though. There's going to be a time when we will have to pay the piper. I suspect we will hear other stories in the future, maybe not like the fraud in Wells Fargo, but businesses will take risks. They will walk that fine line and think, well, if we get caught, we'll just pay a fine. But until then, let's reap the financial rewards. I do expect some homes to go into foreclosure when that forbearance ends. The thing is, there's no such thing as a free lunch. And right now, it feels like we are sitting on a financial ticking time bomb. Let me know what your thoughts and opinions are below. And if you enjoyed this video, be sure to hit that, thumbs up thing and ring the bell, do all of that. Thank you for spending time with me. Until next time, remember, you're beautiful and I love you.